Today, I am joined in studio by none other than Mr. Rick Kallmeyer, of course. Thank you for being here again, Rick.
It's a pleasure.
We've got a very, very special guest joining us from his home state. You in Ohio, Dennis? Is that right? You're
Kentucky, Ohio.
All right. So we've got Dennis Owens, life expert extraordinaire, coming in to talk to us a little bit about his history in the life insurance space, his feels on the life insurance market, and how he approaches the life sale. He's going to talk to all of us this week a little bit about that. Dennis, thank you so much for doing this. It's a great pleasure. And when I talked with Ryan McCarty a little bit about wanting to do a life insurance show, he had mentioned y'all had a conversation about your life insurance process, and he said there'd be nobody better for me to bring on the show than you to talk a little bit about life insurance and your process. So thank you for doing this.
Thank you, Alex.
So, Rick, how many calls? I mean, we get a ton of calls, obviously, about life insurance process. A lot of old annuity dogs that just want to sell annuities. Life insurance takes a back seat sometimes. Obviously, this is something that we needed to do.
Yeah, absolutely. Absolutely. Of course, we're annuity focused and do a lot of annuity business, but a lot of guys do a lot of life insurance. So great to get some content out there about it.
Okay. Well, Dennis, talk to us a little bit about maybe let's start with how you got into the life insurance space. Have you always been doing life insurance sales? And then we'll kind of talk a little bit about your process and how you bring the life conversation into your sales process.
Okay. Well, I actually started in the industry with the biggest investment firm in the world in 1987 on a Black Monday. It was my first day. And what I went into was I found that it was I majored in life insurance then, is with Prudential on the life insurance side. And as an agent, I was there about a year and a half. Then I went into sales, become a sales manager. And at that time, is when I learned to develop on sales, larger sales. When I first started with the company, they sold nothing but little policies. Our area up here, they sold debit policies and very small life insurance policies. And I'm a very lazy guy, so I wanted to find out how to sell the big policies, and I sell so many of them. So I went to the guys that actually sold there. So I kind of listened to them how they did it.
Sure.
And one thing I found in common was that finding out what people's needs are and assist them to do that with. And I found that Prudential did have a system, it was 6 pages long. And when you were done, you had all the facts.
Right.
And I said, then I still couldn't figure out what people need. If they had, I got, but not what they need. So I developed a 1-page fact and feeling finder. What that is not only did I get their information, and at the same time found out what they wanted to do with what they had, what they want their money to do, their estate to do, where to go, where it's going to pass on. At the same time, it developed 4 or 5 needs for sale.
Sure.
Life insurance or investment. So it talked about the lack of when one spouse dies and their pension, there goes their income. But yet they're sitting on a big IRA. So I developed the fact and feeling finder as in to find out the need and walking through it. And then at the same time, you also, when you have people the same income and say all of a sudden, well, you need to spend like $5,000 out of your $60,000 that you're living on now, that's hard to do. So I learned to reposition assets.
Okay.
In other words, make an asset do a more than one dimensional. I put it in a 5-dimensional investment. It did more than one thing.
Gotcha. So this is positioning tax-free income. This is positioning death benefit. I mean, is that what you were doing? Is that kind of where you were going to? Gotcha.
Exactly.
I like that multi-dimensional investment. That's a really great word for it.
Yep.
What is you're repositioning an asset that does one thing.
Right.
If it's an asset, it's simply to grow. If it's deferred or not deferred, non-comp, it's either grown one way or another, causing a taxable event.
Yeah.
And all what their needs are, if they need life insurance, or it also goes along with the person. we have, there's two types of people, aren't they? There's people that are, there are people that are giving, that care about their family. You have to establish what they are.
Okay.
And find out what level you are with them. Is that what you want their investment to do? Is it for them or is it for other people?
Sure.
You know, the combination. So it's the same sale that's establishing what is their need for, what's in it for them.
So if I'm somebody that is looking for, to use this for myself in retirement, that you're kind of diminishing the death benefit of it, making it more about building cash value. What's your thought process for that person?
Well, okay, let's take you for example.
Okay.
If you worked at another job part again here, and you're sitting on an IRA that you acquired, and there's a couple $100,000 sitting there, and you put it off into an investment, and now you're doing another job, doing another 401k, and down the road is that you can't get to that IRA, right? You're just letting it grow. Well, we know that you can draw from an IRA prior. That's one avenue, is doing a 72T.
Yeah.
Mm-hmm.
Take it now, take it over a period of 10 years or whatever it is that they until they're 59 and a half, repositioning that asset into that life insurance policy. You're converting an IRA at the same time. And it gives them more, and they're getting their money back on the life insurance part. That's just one thing.
That's very impressive. And I mean, I definitely have heard a lot of advisors approaching life insurance sale and not one.
So you're taking the 72T and using the funds from the 72T to fund a life insurance policy, if I heard that right.
Mm-hmm.
Yeah, very interesting.
And what you do is you take enough out to leave it for the taxes. Literally, if you're moving $10,000, $15,000, leave the percentage in for the taxes. Now you've got after-tax dollars put into the investment.
Beautiful.
Yeah. So that's one app, moving assets.
Do you have troubles with so when I think about advisors and life insurance, they get really strung up on the follow through, getting the case through. It's a lot of headaches. Are you using more simplified issue products? Are you using fully underwritten products? And if so, what are the headaches that you run into, if any?
Well, it's still if they're physically able to get it. Naturally, what's the best return? Now, there's some life insurance policies that people like that they could put it in today and get it out tomorrow, which they don't have very few of them anymore. But the idea of that, in other words, when do they need this money is which type of investment, which life insurance I'm going into. Do I want to maximize the life for them or to accumulate more cash value? And that would tell you what kind of life insurance they're going to take. But the follow through is that right up front, that's the other thing about it is, if I can do this for you,
right? This
is an, and when you get it, you pretty well locked it in, saying, "Hey, we did it. We got you issued."
Yeah.
So understand the client is the most important thing. Are they able to get issued?
And that's where that fact and feeling fact finder comes in. Is you're doing a very thorough deep dive on not only their assets but their health and medications that they might be on. Is that right?
Well, in general anymore, the medication, when you're younger on a medication, it's just rated. Right. Right. It all depends on when you're going to. But I mean, I've written people at 75, 78.
Oh, wow.
In other words, don't go by the age. It's the idea. If you have the asset, it still does the same thing.
Mm-hmm.
Okay. So yeah, I'm not sure if they've had type 2, diabetes, cancer, strokes. Naturally, I wouldn't talk to them about it.
Sure.
But an avenue that we could go. Or I'm very big on second to die. That's another thing. If you have that, then you got a husband and a wife. One of them usually in physically good enough condition. If they're passing the money on to the heirs, what's better than a second to die?
Mm-hmm. Nothing. That's a good point.
Yep.
That's a good point.
Still care on it for the second one.
So primarily, what is the age demographic that you're talking to? Obviously, you do go up, but there's got to be a sweet spot that you're primarily the second you see maybe age in a certain financial situation that you're starting to talk to them about this policy.
There again, I market people naturally 55 up, but I have clients 45 and around 40 and up.
Sure.
Well, you could 45 if they have a 401k somewhere else. You know, if it's life insurance they're trying to fund, you got to find an avenue, or they have assets that are sitting in their account. You know, it doesn't have to be qualified money. The idea is having an asset that you can move from here to there. It does establish to fund the life insurance. I do mostly 5 and 7 year pay.
Okay. All right.
Still sticking with an IUL on those?
Yes.
Okay.
What is your opinion of IUL versus UL or whole life products? I mean,
well, IUL is the best index naturally. I done stay away from variables. That's what I started with.
Mm-hmm.
Yeah.
Variable, it got terrible. I kind of backed off of it and got big in annuities for that reason. And then when life insurance changed back to the index life, they have it now that when you can take the money out years ago, if you were telling them that you could take this money out for a pension down the road, you were not telling them the truth because it would lapse.
Yeah.
Have a non-lapse policies, and you can do it that way. You can keep taking it out without lapsing the policy.
Right.
They are designed for that.
Okay. The IULs are, or the non-lapse policies are? Yeah.
Non-lapse, if they guarantee it, if they'll have it each policy, they'll tell you when you're doing it.
Right. Okay. So if they're not doing that, what are you suggesting the IUL for then? It's just as needed tax-free income kind of thing, or?
Well, no, if they're doing it for tax-free, you better have a policy that will not lapse.
Okay. All right. That makes sense.
That makes the company you're using. Yes.
Do you have some favorite companies lately or anything like that? Or do you kind of, just.
A couple of them, where I used to do it, where they can put the money in and take it out the next day with no penalties. They got rid of those. I did a lot of those. I really like those.
Yeah.
And also second dies are harder to find.
Yeah.
I mean, you got to go to companies like Prudential and them. They have now some seconds of dies are harder to find, but they're still great. You can get them.
Sure. Yeah. I didn't know that. I didn't know second to dies were becoming
a little bit trickier on the IUL space.
Yeah.
Now, Dennis, it's interesting for me to hear. I know a lot of people when they're looking at an IUL strategy, especially when you talk to a lot of like carrier reps like me on the life side, a lot of them typically structure more of it of a 10 to 15 year pay. So I guess what kind of premiums are you doing for a 5 to 7 and what's structuring with the policy on that? It sounds like you're funding it pretty quickly. How do you stop it from mecking?
Well, that's the formula they have. It's a 5 and a 7. They'll tell you illustration.
Okay.
How much they'll tell you in your illustration how much that's the opposite is that I have a lump sum of money coming in. Good example. I had a client that had an Allianz that did a 5-10 payout. Mm-hmm. Okay. Mm-hmm. And each year they were going to get $50,000 for 5 years, which they didn't know that. That's once I established it for them, they needed to put it somewhere. Gotcha. So they took the opposite. I took the $50,000 after taxes on it. That was what the premium was for a 5-year payout. I mean, paid up policy. Then the life was established on the other end, telling you how much life you would get. You'd use the dollar amount to tell you how much you were funding.
Gotcha.
How much you're there.
And how long are you typically deferring it after that point? Till you start taking income. I said, how long are you typically deferring those like 5 to 7 pays?
Well, you go 10 years.
Okay.
You always want to make sure they're over 10 years before you ever set up. They'll start drawing, and their 11th year at the soonest.
That's what I was missing. A lot of people will do like a 10-year funding, stretch that funding schedule out instead of doing like a 5 to 7 year pay. They'll do like a 10 pay and then start taking income a little bit quicker.
Is it year 10 of the policy or is it year 10 after funding has completed? Like, so after the 5 pay, 10 more years then?
After the 11th year is the best time to start on the payout on life insurance policy.
Gotcha. Yep. Wow.
Makes sense. I was thinking you do like a 5 pay, 7 pay, and then you're like taking the income out like 2-3 years later or something like that. And I was like, that doesn't make sense to me. I don't know if you can do that, but yeah, if you're still stretching it for another either 6 or 7 years, 8 years, whatever, that's giving the policy enough time to grow and the death benefit to cash value to even out. Okay, cool. Very cool. Very cool.
Yeah.
Very.
But the idea of it is it's there. And I've had they were doctors. They put in $50,000 a year, and period of time they wanted to buy a house. Naturally, we can borrow out of it since you haven't mexed it, and you can get to that money in 2 days. But they'll put it back in. But it's another avenue. It's sitting there They can still use the money if they had to for a temporary time and put it back in if they want to. And not that. All kind of reasons for a person to move money in there and be able to get to a sale at the same time if they had to.
That is really, it is super multidimensional.
Yeah. Again, all the same while still providing a death benefit if you do pass away, getting more growth than you're going to get in the annuity space, right? I mean, the par rates and cap rates on IULs are substantially higher than an annuity is.
Yeah.
Oh, yeah. And also you get long-term care, critical illness. Had a client got a $550,000 life insurance payout when he got cancer.
Explain the living benefits to those that don't necessarily know that. What living benefits can somebody expect from some of the new age life insurance policies out there?
When people hear life insurance, they're saying, well, okay, I got to die for it to pay out. Okay, remember I said it was 5-dimensional. It does 5 different things. Life insurance is the last thing that it does. It'll pay out to the person at a tax-free status, guaranteed to be there. Yeah. Who has an investment that you know, in a variable or even an index, that can tell you how much it's going to be in 10, 15, 20 years?
Yeah.
The dollar amount. It's a guaranteed payout. That's the 5th thing. But the other thing is that you can use it if you get cancer. If you get any kind of disease that you're critical ill, you can get the money now if you need it. If you get cancer and need expiratory, and that way it can cure you, you still have your money. And I mean, you've got to do it with and still be able to. I did this, the first one I ever sold, I was one of the first ones to have. I did it in 90 with Prudential. I sold it to a 22-year-old man, and he actually got AIDS. And he had a $100,000 policy. And back in those days, if you get AIDS, when you can't work, nobody wants to be around. This guy actually received $80,000 to live on. Wow. In other words, live the benefit on there. You can use it for long-term care, critical illness. It has multiple things it does.
It really is a powerful tool, and it's definitely becoming more and more popular conversation. We talk to newer agents into the business. They're seeing the light a lot quicker. I mean, I think a lot of people, I don't know, somewhere along the line, before I ever came in the business, got real sour on life insurance for no reason.
Well, they did get to where they didn't have a lot of features that were good.
Okay.
They would last. The variables would last. You get to page 65 and they triple your premium. Yeah. If you didn't put it in, ULs would lapse. They're lapsing. 65% of them lapse.
Wow.
The underfunded.
Yeah.
Agents were underfunding the policies just to sell them.
Yeah.
So the policies are a lot better now.
Yeah.
And then use them properly, fund them properly. They're a great investment. The first sale on a life insurance policy to the agent. They got to believe.
Yeah. Yeah, I agree, man. That seems to be. I didn't know that the product had fallen so far from its previous grace, and that's probably exactly why they had such a sour taste in their mouth. But then, to anybody watching, that's from Dennis's lips to your ears. This is a guy that writes a ton of life insurance business out there, and self-admittedly says the life insurance game was trash for a while.
Yep.
Is saying to come back, and it is so multidimensional. It's a no-brainer, especially in the federal space. Do you talk about this with federal employees much?
I haven't done real good on the life of the federal employees, to be honest with you.
Okay, all right. Well, I would say this: it's something that maybe you, myself, and maybe some smarter minds than myself should get together and talk about, because there's something to be had there. They have an abysmal life insurance policy that's going to explode on them.
It is.
Yeah, it's not good. They generally just quickly default to that 50% survivor annuity offered by their pension, rather than contemplating somehow looking at supplemental life insurance benefits and taking the unreduced amount from their pension. If we could figure out a pitch that worked well, and I'd love to pick your brain a little bit more on that, maybe at another venue, there's an opportunity.
I'd like to tell you another avenue that I do on life insurance.
Okay.
I do a lot of trust work, and I put life insurance in trust a lot. A lot of agents don't do trust because they're not familiar with them. But it's a vehicle. That the thing about a trust is that when you put an annuity into a trust, okay, an irrevocable trust trying to retain the estate,
Okay.
It's very high tax when it comes out, the interest. If when you start using the money inside or anything like that, it has a very high tax rate. Life insurance goes through with no taxable event.
Really?
If let's say you got a client, I have some that are sitting on $2 or $3 million and they're in their 90s, okay, or late 80s, and they're uninsurable. I would actually move some of the money on their kids and put life insurance on the kids, moving over maybe 40, 50, 60,000 a year, owned by the trust. The parents still own it. But when they pass away, the life policy goes to the kids.
So, the trust is a policy owner, the parents are the insured, and the kids are the beneficiaries, or is the trust the beneficiary again?
The kids are the insured.
Okay.
And the trust owns it.
Gotcha.
You have multiple trusts. Is that if they die, the life policy comes back in there too and divided by them.
Gotcha.
It doesn't pay out until the parents pass away.
Right.
And doesn't taxable event.
It's just so much you can do with it.
Yeah, that's cool.
You got outside the box. In other words, what you can do to help them and draw better interest. If you're limited and you don't want to put them in risky and you're doing annuities, well, they're too old to do annuities with.
Right.
But the kids on there do a life policy on them. Now they've got a great investment themselves for the rest of their lives.
Yeah.
Change ownership is all you.
Wow.
Massive for older clients. I mean, you see that all the time. People struggling with any client over 85 years
Over
old.
85, or they're over 80, and they just the annuity options are such slim pickings that they don't, it doesn't necessarily fit their needs.
Yep. Happens all the time. I had a lady that was, I think, 87 yesterday. I was running a quote for, and we're looking at either the 3-year or 5-year option. She was like, put it in the 5-year, because if I do the 3-year, I'll be 9-1 when it matures, and I can't renew it with anything. There's nothing I can do with the money after, so let's go ahead and put 2 more years on it.
Huh.
So that's crafty. I like that a lot.
So this comes down, we were talking before we went on today, you do an estate planning and Social Security workshop together. So that obviously you're doing a lot of estate planning with your clients. Right. Yeah,
I do. I work with lawyers a lot. And I tell you what, just like the one last night, the things that are coming around now, like inherited IRAs, had 10-year payout, that's nothing but created a bigger sale opportunity for us.
Mm-hmm.
How so?
Well, inherited IRAs, you could have $1 million IRA passed on to your kids for 50 years.
Yeah.
Passed to their.
Yeah.
Okay. Well, now the inherited IRAs have to be paid out in 10 years and cannot be passed on.
Right. Right.
So what do you get that 10 years payout? What does it go into? Life insurance policy passed on to the kids.
Yep.
It's
Dennis,
creative finding.
How tricky is it for the average, I guess we'll just say insurance-only agent, to pick up estate planning workshops and learn that world?
How tricky is it?
Yeah. To learn the estate planning world for really specifically an insurance-only advisor, is there a large, I guess, bridge to getting into that space, to understanding that space? I mean, I would assume personally it's got to be a complicated topic.
Well, it's not. The hardest thing is naturally understanding trust. Okay.
Yeah.
What's funny in our industry, don't take this the wrong way. Bosses, your people over you, you guys probably have done your own estate planning.
Mm-hmm.
Don't have trust. I have trust. I got 7 LLCs.
Mm-hmm.
Okay. But the idea of it is the people you work with, if you don't do it, how do you, I came from another company. The guy sold his industry out, never had a trust.
Yeah.
Worth millions and millions of dollars in the insurance field, in the investment world.
Yep.
Didn't have a trust. He didn't have a trust. That means he's not working with his clients to get them trust.
Yep.
For a guy who want to be 1% better, you just got to know and how it all ties in.
Yeah.
So the idea of it is that you got to study it. You got to work with it. And the more you do, when I go and take a client to do a trust, I go with them.
Oh.
Matter of fact, the lawyer, I take them to the lawyer. I get a negotiated the price to do it. And we sit together.
Okay.
And we're part of it. Know what we're going to do when we sit down. That's mean you got to know what you're doing though. And it ties into in the trust, whether you want to protect it for estate road, as in, am I still on? Okay.
Yep.
In other words, protect the money for Medicaid spend down, what some people plan for that. So they move their different ways. So that's the got to understand how trust work, where you can put them into. And then it's funny working with insurance companies. They're funny about that because they don't understand them all the time.
Mm-hmm. They
So you got to help.
I mean,
it's a huge part, man. You see so many advisors when they have something like that, whether it be taxes or estate planning or anything that they don't strictly focus on, rather just hand their client a business card and be like, hey, go see my estate planning attorney, go talk to him, right? And come back when you're done. We'll talk about the rest of it. That's really cool to go sit down with the client and the estate planning attorney, even if you don't know it well, to just be in the room and like, I'm here too, you'll pick it up over time. But I like that. That's really cool.
Yeah, exactly. Mm-hmm. And then exactly right. You piece it up. And then when you understand it, then you'll advise them before that. But I always want to I never send a client to a lawyer. I go with them to the appointment.
That's what's missing from so many advisors that deal in the estate planning world and have failed there, or just working with referrals with an estate planning attorney. That's what's missing.
Yep.
That you end up leaving and saying, oh yeah, I got an estate planning attorney, go work with them or whatever. And then it never reciprocates back to you because they feel like you're not involved anymore.
Yeah. I mean, so you lose all the kudos too, right? You send it to them and all the work that got done on the estate planning to fix things to help you. Like, you don't get any of the credit that the estate planning thing.
Plus, you're hoping they come back to you, or you at least have to be like a bird dog on the phone to get them back in. Like, oh, we got to fund that trust,
They
Yep.
listen to them, but they pay them.
Yeah.
And because they pay them, they think they know more.
Right.
True.
Right. Well, I think that's super powerful. And I love the angle of the 10-pay inheritance. What a perfect setup for our 10-pay life insurance.
Yeah. For those non-spousal stretches.
Home run.
Mm-hmm.
Dennis, do you think there's anything else that we should know for advisors that are looking to jump into the life business? What is it that we should know before we embark on that? Or is it just, let's get going, start doing it, stop hiding behind old facts?
Yeah, well, I tell you what, it still goes back to the work of sitting down with people and getting the information.
Yeah.
And nothing better than studying the old Sandler selling system.
Yes.
They teach, get the information. One of the best things to do is knowledge is power. The more you train yourself, the better you are.
I agree with that. 1% better, something Dennis Owens lives by for sure. Be 1% better. I love that. I appreciate you coming on and sharing this with us, giving us some ideas, and we'll definitely pick apart this maybe a little bit more. I'd love to get on the horn with you, talk a little bit about the federal opportunity. Maybe we'll talk a little bit about how to implement this into into the federal world. Rick, anything else?
No, it's great. At least for this one, it's great.
Dennis, thank you so much for joining us. Nice and quick, to the point. I love it. I appreciate you jumping in and sharing a little bit of life wisdom with us.